Okay. So, as Roger was saying earlier, we do have that nice 100% bonus depreciation this year with anything that's got a class life under 20 years or under. So that's going to be a big plus for us. Now, as we mentioned yesterday on the 1099K, um, we're at, we're back up at $20,000 being paid through a merchant or 200 transactions, whichever comes first. And that would facilitate them to issue a 1099K. Now, this is the one thing that's kind of interesting. You remember, we've always played with R&D, research and development. And remember, for the last few years, we've had some R&D credits that you have to spread over time, and it can only be used for payroll. Well, we're back now. R&D is now 100% deductible, just like bonus depreciation. So be aware of the fact that we're returning to some of the old benefits that we used to see out there. Okay. And again, QBID, you heard me talk about this. QBID, the phase out is the big change here. The phase out on qualified business income deduction used to be 100,000. It's now up to 150,000 for married filing jointly. It's up to 75,000 for single or head of household. So your program is going to watch this for you, but you need to be familiar with it. If you're doing tax planning, you need to know that you got a $150,000 phase out now instead of a $100,000 phase out. Okay, let's see what else we've got here. Let's go next slide, Jan. Okay, and I know I'm going over some of the stuff that we hit yesterday. I think I was trying to speed up and get through some of this. Just remember that the estate and gift tax exemption this year is just $10,000 shy of $14 million. So what does that mean if you have a couple and one of them passes away? Well, you can go ahead and transfer any unused amount of this lifetime exemption over to the remaining spouse. When would that come in handy for you? Well, probably when you got a very wealthy client. Sometimes you have to ask the question, what were you and your spouse worth? What are you worth right now financially? You might be surprised. You know, again, this takes you up to almost 28 million. And as of next year, 2026, if you have one that dies in 2026, it's up to 15 million apiece or 30 million jointly. Remember, you have up to 5 years now to claim DSUE. What does that stand for? Yeah, I'm trying to figure that one out too. Deceased, unused, deceased spouse, unused exemption credit, or exemption, yeah, exemption. Yeah, at any rate, we also call that, well, DSUE, okay. But remember, that has to be filled out on Form 706. But it does not mean you fill out the whole form. It means that you file to go ahead and transfer any unused portion of the exemption from the deceased to the surviving spouse. Okay? Like I said, for most of us, it's going to be a non-event. Because unless you got somebody that's really wealthy or has a lot of wealth, they're not going to be hitting, for a married couple, they're not going to be hitting $30 million for the year. At least I don't have any clients like that. I don't know if any of you do, but okay. So what else we got here? Go back one slide, Jim, if you would. Okay. And again, on the charitable contributions, we did discuss this. Thank you. All right, let's move forward. I'm sorry, Jim, you're ahead of me, but you're right where you need to be. School expense for educators. Again, remember that's a $300 deduction for each educator. But what if they have more than $300? Well, now it can go back on to itemized deductions, Schedule A, subject to 2%? No. It's going to have its own drop-down screen, just like gambling losses do, and you're going to find it in that drop-down screen. It's going to be excess expenses for educators above the $300. So how many of them come in and you're sitting down and they're giving you stuff, and before you know it, you got $1,000 or $1,200 worth of teachers' expenses? Well, Ben, can I take more than 300? Well, if you're able to itemize, yeah, we can now. We got a spot for it.
Is there a cap?
Do what?
Is there a cap?
I don't think there is. I think you get anything above that. Again, you'd want to be able to prove it. You'd want to make sure they have receipts, but this now goes beyond just educators. It could be counselors, principals, coaches, administrators, or even aides with at least 900 hours a year working for the school system. The only thing I didn't see was janitors, but everybody else seems to be in there.
Bus drivers.
Bus drivers, thank you. I didn't see bus drivers either. But, you know, it seems like they're really opening it up for people in the education arena. How's that, Mary?
The spots on Schedule A. When you said there's a spot for it, if you go.
Oh, there is a spot for it. Yeah, let me just repeat that to the group online. You need to change or? Oh, okay. Yeah, leave it there. That's fine. No, it's okay. All right. So to repeat her question, there is a spot on Schedule A for this. Again, it's in a drop-down screen. So that's assuming they can itemize. Now, what if you had a school teacher who was married to somebody that was a big white-collar exec bringing in $300,000 a year? Well, if you had that situation, maybe with the increase in the SALT tax, they might actually be able to itemize this year. And in that case, these educator expenses would be useful. So, just something to kick around. All right, well, guess what? The phase out on itemized deductions is now back. You know, we had a nice run without it, but you knew eventually, if you've been doing this long enough, they were going to come back and play with it again. And it is back. And now if you're in the 37% tax bracket and you go above that, there's a phase out of 2/37 or 5 and I'm not even going to go down that thing, but a percentage just under 5.5% that it's going to reduce if you're in the 37% tax bracket. Now, will we have to do this manually? No. Will our computer handle it? Yes. But might we have to explain this to our tax client? Probably. And if they're young and they haven't been through this before, Ben, I think you're messing up on my tax return. What are you trying to do? Taking away my itemized deductions. So be ready for this, because if you have wealthy clients and they're in that 37% tax bracket and they itemize, there will be a reduction for them on their itemized deductions. Okay. Gambling losses. Oh, boy, I should have seen this coming. You know, it's bad enough that gamblers are not able to take losses for more than what they won. So if they got a W-2G and you got them reporting $10,000 in this particular example in winnings, what's the maximum that they can deduct in losses? 10,000, not a dime more. So first of all, they can't do anything with their losses that exceed their winnings. And now they're telling them, well, we think you're getting too good of a deal here. We're only going to let you take 90% of your losses now. So if they won $10,000, the maximum amount that the program is going to let them take for losses is what? $9,000. So they're still going to be on the hook for $1,000 in gambling winnings under this particular example. So be aware of the fact that your computer is going to be pulling all kinds of new tricks on you this year. You need to be aware of why so you can explain it to your client. Otherwise, you're going to be scratching your head like a lot of us saying, why did it do that? Have you ever had your program do something and you didn't know what was causing it? It's frustrating because you're supposed to be the one that knows. For you folks online, yeah, it's going to be interesting this year. So be ready. You want to read up on this, be familiar with it, and know why and be able to explain it to your client when the program does something that looks unfamiliar. There's all kinds of interesting scenarios. Okay. Moving expenses. It'll be extended now to the intelligence agencies. Up to this point, over the last few years, who's the only group that gets to take off moving expense? Military, absolutely right. Well, now we add in a lot of these three-letter agencies that are in intelligence. CIA, FBI, Homeland Security, But just be aware of the fact that now, and believe me, if the government tells them, oh, you be sure to tell your tax advisor that you can take off your moving expense, believe me, they're going to come in with remember there used to be a form that we would get. I don't remember the number at this point. 3903. Was it 3903? Thank you. Boy, good memory.
I have military.
Kelly, yeah. Okay. So the 3903 is going to be something that you fill out to knock out these moving expenses, assuming that the government hasn't picked up that expense and paid it for them. Now, again, if they've been reimbursed, do they still get a deduction? No, only if it's been added back as income on their W-2. And so you might have to do a little research to make sure that what they're trying to deduct, they're actually entitled to deduct. Okay, moving expenses. Let's see what else we've got here. Oh, man. You know what? How many of you have people that ride bicycles and commute to work on a bicycle? I got two of them. And boy, every year, yep, man, I'm still getting that $30 a month for bicycle maintenance and repair and upkeep. Well, guess what? This year, they're going to be so disappointed because it's no longer a fringe benefit. There's no reimbursement from the employer for your bicycle. So if you want to continue to ride your bike for the fresh air and the exercise, God love you. I think you need to. Get out there, stay fit. Now again, I have a lot of them that share a lot of war stories with me too about people out on the road that when they want to get rid of road rage and they see a guy on a bicycle or a gal on a bicycle, that's a target for them. I mean, I've had a lot of them that have had their wheels bent and knocked into curbs, knocked into telephone poles because the other car did not show them the respect. Now, this has nothing to do with your taxes, but in the state of Georgia, at least be familiar with this. If there's somebody in a bicycle, you have to give them, as a driver, 3 feet between you and their bicycle. And if you don't, and they get hurt, guess who can get charged with that accident? The driver of the car. So you got to give them a 3-foot berth or width, whatever, from the bicycle to your car. which means lots of times you have to do what? Cross the yellow lane to get around them. So just be aware. I don't want any of our folks, either online or here, to wind up saying, wow, of all things, I got arrested for being too close to somebody on a bicycle. Well, you know, is that going to happen unless there's an accident? Probably not, but you never know. Okay, child independent care. We talked about this earlier yesterday. It's going from 20%, it's now 20 to 50%. So if your income is low enough and you got at least 2 kids in childcare, you know, you can pick up $3,000 a child. What used to be a $600 per child credit, or $1,200 total for 2 children, now goes to as high as $3,000 if you have the right situation. So this could be a nice refund for somebody that's a single mom struggling to make ends meet. This would be a nice little refund pickup for them. Okay, standard deductions. These are just the breakdowns. I'm not going to make a big deal of it, but they've gone up and they'll continue to go up next year. Just be aware of the fact that if you're over 65, single people get more for their additional benefit of $2,000 versus somebody that's married over 65 that only gets $1,600. Well, in government math, that works. So that's all I can tell you.
And you have that potential 6,000 per.
But that's correct. Absolutely, absolutely. So you got that additional 6,000 that's going to kick in on top of that this year, as long as your joint income is below 150 or your single income is below 75,000. So keep that in mind. All right, next slide, Jam. All right, kiddie tax returns. Now, how many of you do kiddie tax returns? Yeah, I do too. I've had to get to the point where I just finally told them, I said, I got to charge you more. You know, because I'm having to do all these separate tax returns. And that Schedule H is a booger bear. No, it's not H. What's the form for? I forgot what it is. 8315, 8314, 8315.
I think it's 50.
Okay. Okay. But at any rate, it's in your program. And let's just say if you have multiple children and they all have income, you have to use, for each one, you got to look at what the other kids have made in dividends and interest and include it on the form for that kid. Requires so many manual computations that it's just not charging a good dollar for it, then why are you doing it?
And then also sometimes it goes on the parents. You have to make sure the parents done first so you can put the.
Okay, she said, now if it's involved with the parents, you've got the parents' return you got to do first in order to find out what bracket the tax the kids are going to be dealing with by paying the parents' rate. Now, can they do a form? Is it 8415? It's 83. No, but there's is 80. Yeah, 80. I think it's 8415 that says you can claim it now. Claim all the income for the kids on the parents' return. So believe me, that's an option. You can say, listen, your kids are going to be taxed, except for maybe $1,050 a piece, not in tax, but in income. Your kids are going to get taxed anyway at the parents' rate. Why not just shove all the kids' income over to the parents' return? And you can do that with an 83 or an 8415.
It's actually 8650 now. I just saw it up there.
Okay, well, good. You see, I don't even read my own notes sometimes. Okay, there they go.
Yeah.
8615. So, no, the 8814 is the option for the parents. The 8615 is to fill it out on each of the kids independently, along with their own personal tax return. All right, children's wages this year can go up to $15,000 with investment income not exceeding $450 of that total, and they'll pay no tax. The exception is what? The 1099 that comes
I
in
see.
for some poor kid that served as a lifeguard. They made $1,200 as a lifeguard and they wind up owing taxes. Ben, you must have done something wrong. My kid only made $1,200. How come he owes tax? Well, anything above 400 on Social Security is taxable, isn't it? They don't want to hear that. And I'll try to tell them, listen, tell your kid to ask up front, are you going to pay me on a W-2 as a lifeguard? If not, I don't want to get stuck paying taxes at the end of the year because you don't want to withhold Social Security on me. Social Security and Medicare. So be aware that that's still out there. And a qualified relative. How many of you have qualified relatives? Got Uncle Willie in the basement? Aunt Marge up in the attic? You know?
Along with the cats.
If you've got an other relative, if they earn more than $5,200, you notice I said earn, they earn more than $5,200, you can no longer claim them as an other relative. What if they've got a kid that's 38 years old still living at home in the basement?
Again, it's
Well, if that kid makes over $5,200 a year, they can no longer claim that kid. Yeah, but Ben, we're supporting him and everything. And well, he went out and made enough money. How did he make the money? Oh, he's a Facebook influencer. Facebook sent him a check. He makes $110 a month. No, a week. $110 a week. Okay. Is that over $5,200 for the year? Yeah.
Mm-hmm.
So, be aware of that fact that other relative will work until earned income gets to this point. Does Social Security count against the $5,200?
no.
No, it doesn't. Does retirement income? It's not earned.
It's not earned.
So be aware that it is earned income that we're talking about here. Okay. Superseding return. You've heard me talk about this before. If you have sent out a tax return and either you mess something up or the taxpayer messed something up, and you say, oh, man, if I could get a redo on this, if there was any way just to pull it back, there is. It's called a superseding return. And I'm surprised and pleased to tell you most tax programs now have a box for superseding return so you don't have to mail it in manually.
Yep.
What does this do? It's not a 1040X. It overrides everything that was filed electronically on that first return. What do I mean by override? It's as if it was never there.
But you can e-file it again too, which is great.
Well, if you file a 1040X, your original stays on file.
No, I meant, but you can e-file the superseding too.
Yes, you can. That's the benefit these days.
That's what I love.
You can now check the box for superseding return, and it's going to be as if it never happened. So whatever mess up was there, either by the client or by you, you can make it all go away. So be aware, but you have to file it when? Before the deadline. So if
Okay.
you're dealing with entity returns that issue K1s, that means you have a March 15th deadline, don't you? Not an April 15th. So you got to get it in before the normal deadline, otherwise it can't be superseding. Okay, new slide, Jim. All right, net operating losses. All right, no carrybacks, only carry forwards. It's been that way for a while. No expiration date on your carry forwards. So as long as you got an NOL, you can continue to take it. And it's still the 80% restriction rule. It's back for 2025. I was sort of expecting that they'd take that back to 100%, but they did not. They did not. They left it at 80%. Your program's going to handle that automatically for you. Remember, there is an AGI income cap for NOLs. So if you've got an income cap What happens if your income goes to like 700,000? Means you're going to get cut off on your NOL at 626,000 for married filing jointly, or 313,000 for single head household. So if people have big NOLs and they think, well, that NOL is going to wipe out most of my income, at least up to 80%. If they're making more than these caps, they're not going to get any NOL after they hit the cap. So just be aware of the fact if your program, like your program's going to be doing all kinds of adjusting by itself this year, and you're looking at it and saying, but they got a $100,000 NOL. Why can't they take it? Well, if their income gets up above these caps, that's why they can't take it. So it's not just 80% anymore. It's going to be capped at these income levels. Why do we have odd numbers up there? Because it's tied to the cost of living index. Now, that originally was set up for 500,000 and I think 250. And what happened was with cost of living over the last 6-8 years, it's crept up to these amounts right now. Okay, let's see where we got. All right. Again, this is just reiterating with the new law, the 30% energy credit for wind, solar, geothermal, all these others is going to expire on December 31st of this year, along with the tankless water boilers and the biomass stoves, along with the insulation, advanced HVAC audits, and energy efficient windows and doors.
Why do you think? I mean,
All of
doesn't
it
make any
expires
sense.
on December 31st.
But why that? I mean, these were good things.
I agree. Congress, you know,
Makes sense.
they did some real horse trading, and this is what came out from it. So I didn't think there were any horses in Washington. So go ahead, Jim. The next slide here. All right. Again, these rascals, you're now looking at something that as of September 30th no longer exists. The only people that are going to have a shot at this is those that bought one of these energy efficient cars where the battery was assembled in the US and all these other conditions that were out there. If they bought it before September 30th, they still qualify as long as they haven't made too much money. Remember, there's an income cap on these things too. 300,000 for married, 150 for
Do you know
single, married, filing, separate.
I was surprised. I did married filing separate for a couple, and they got the credit.
Their income was above the threshold?
But when I did married filing separate, and it was in the wife's name with the lower income. Now, it may come back to bite them, but I couldn't find any law that said you couldn't file married filing separate.
Oh, you should be able to. Let's go.
Oh,
Married filing separately, if the one that filed was under 150,000
and she had it in her name, so she had the lower
and she was
income.
under 150,
So
you
she
should
got
be
the
good.
7,500. So we did it.
you can start sleeping at night again.
I know.
You don't have to worry about this
Now
one
this is
anymore.
over. No, it's
Okay.
serious. Now we just wait for 2 more years till the
All right.
returns expire.
Again, you can see these are all things that we no longer have to worry about. Now, the one thing that scares me is, remember, as of last year, the dealers could start giving the $7,500 credit as a reduction off the sales price.
And it should, because my
And-
client just paid it
and
back to the IRS.
And if you didn't ask your client, hey, did you buy an EV last year and get a $7,500 credit? If you don't ask that question, you think the client's going to volunteer that information for you? So what's going to happen with the CP2000 when they come back and try to regain that $7,500? Why would they do that? Because you haven't filled out the form asking for it. It's a Mother May I form.
Right.
Mother may I, from last March when I bought that EV and the dealer took it off at the location where I bought the EV, I thought it was all taken care of. Ben, you never asked me, Ben. Who
Never
gets
told me.
blamed for a lot of this? Ben, you pay the $7,500. It's your fault. How many clients do we have that try to play that game?
Well, my
Online,
client,
you play that game too, don't you?
my client made too much money because he had forgotten about a capital gain. So when I told him he owed a boatload, he's like, how? And I said, you made too much money. He's like, no, I didn't. I have this, this, this. I went, what about that? He's like, never mind.
Yep. It's amazing how they try to play it against us. And they think when they owe the tax, it should be our responsibility to pay the tax. I'll tell them right up front, if I messed up something up, yeah, I'll pay the interest and the penalty. But the tax was always there
Still
for you
yours.
to pay. I had nothing to do with that. Me filing a mistake doesn't make your tax go away. But they all want to put this is why I don't think we're ever going to be looking for another job or profession. This is where I disagree a little bit with Roger, is that because of the fact that they need somebody to hold accountable for their tax return, they're going to continue to keep us around. Same reason, if you had a medical condition and you went on the internet and pulled up AI and it said, yeah, you need to come down to this hospital where AI robots will surgically take care of whatever's wrong with you. Are you going to jump right in your car and drive down to that place? And yeah, I'm ready for my surgery. No, you're going to want that personal touch from a doctor that explains, is there other options? Can I do something else? That's the same reason we'll always be in demand, because they're going to want somebody to come to with that personal touch. Somebody that will explain it to them. Or if we like the term "splain it,"
Explain.
that works
I
too.
got some explaining.
But you want somebody that can give them a description or an answer for all their questions. And they're not going to get that from AI. So that's the reason I believe we're all going to be around here and working as long as we want to. AI is not going to replace us. The only people that are going to be shifted to AI are those that have simple returns, a couple of W-2s and some interest, mortgage interest and whatever. And they'll continue to use TurboTax or some kind of an automated service. And that's not the client we're looking for anyway, because their loyalty factor usually is they go with the wind. Where can I get my tax return done for the cheapest? And so for that reason, I think we're going to be okay. We'll have plenty of business. All right, let's go to the next slide, Jim. All right, this one's going to go to the used cars. Next slide. Yeah, or it's already gone, excuse me. And the commercial, it's also gone. If they didn't buy a vehicle by September the 30th, they can't get it now. All right, student loan forgiveness. Now, for those that were forgiven on student loans, if you were filling out a tax return for Arkansas, which would be in our realm here, we're in the South, California, Indiana, Minnesota, Mississippi, North Carolina, or Wisconsin, then you could easily be in a situation where the state would charge tax on that money.
Our son, who did not want student loan forgiveness, got it because he works in a low-income medical area. And so he was fine he was living in North Carolina, but he had a boat tax.
So North Carolina taxed him for that forgiveness. Okay.
He was so mad. 'cause
All right.
he didn't want it.
Kelly has an example where her son got hit with North Carolina taxes because he was under a special program where they forgave his student debts as he worked so many years probably in an underprivileged community. And even though the feds forgave his student loan, North Carolina came back and you said a whole boatload of taxes that he had to pay to North Carolina. So just be aware that that's going on. employers can still pay up to $5,250 towards student loans for their employees. Now that same $5,250, if you've seen that before, that's also what they can pay for college tuition for their employees. And here's the real benefit. The benefit is the employer gets to write it off, but the employee gets to treat it as fringe benefits, which is non-taxable. So the employee doesn't pay tax on it and the employer gets the deduction. That's a win-win in my book. Okay. And this runs on through 2025. We'll have to see what happens in 2026. Now, it must be a written plan and it's got to meet all the non-discrimination requirements. Next slide, Jan. Okay. Qualified dividends and long-term capital gains. Again, Roger was showing this earlier. The three brackets, 0, 15%, and 20%. You can see here on your slides, as well as in the material that you have. Every one of you should have a packet of written material. It's probably about 21 pages, I think. But these are the thresholds where it kicks over to the next level, the next rate. Don't forget, if you go above $250,000 married filing jointly, the net investment income tax, or we call it NIT tax, kicks in and you pick up an extra 3.8% that you're going to have to pay on top of your 15 or 20%. All right. Investment income, again, includes capital gains, interest, dividends, annuities, rental income, and royalties. Okay, this is what the funding bill changes, and this is where they fell off. Tuition and fees deduction. You're right, we haven't seen that since 2020. Well, whether it'll ever come back or not, we just don't know. You got a $2 million exclusion on cancellation of debt through the end of 2025. What happens in 2026? Under OB3, everything drops to $750,000 cap. Okay? So up to this point, if they had an existing mortgage that preceded 2018 for up to $2 million, they were still under the exclusion. Mortgage insurance premiums. Yeah, it's on the books, but who's going to qualify? Very, very few people. Remember? We talked about this yesterday. The income threshold is so low that I seriously doubt whether any people that can itemize in those low income areas are going to benefit from mortgage interest deduction. But your computer will control that for you. It'll tell you. Medical expenses, we still got 7.5% deductible. Next slide, Jan. Okay, I'm just shifting over here for a second. I'm going to get my drink and come back. Again, this is the 2025 rates. These are here if you need them. Let's go to the next slide. And the comparison will be 2024 rates. So you got this material in your book. You can look at it if you need to compare. All right, 2025 child tax credit. As I said earlier, this has now gone to $2,200 per child. And is it all refundable? No. The cap is still $1,700 a child. If you have a family that gets to zero tax, they can still pick up an extra $1,700 a child as a refundable credit. All right. And again, children over 16, same condition. It's only $500. It drops off. And other dependents, it also. Now remember, the AGI is unchanged. If you're single, your AGI on child tax credits is still $200,000. If you're married filing joint, it's $400,000. Okay, mileage rate. Woohoo! Gone to 70 cents a mile. And look at those gas prices coming down. Now, whether it's going to change next year, we don't know. But for right, I'm not going to jinx it. I'm not going to jinx it, Kelly. But 70 cents a mile up from 67, that's turning into some serious money. I mean, if you're being reimbursed by your employer for mileage, or if we go to seminars. Now again, for most of you, it's pretty local, but we got some people here from North Carolina and some other places, Tennessee, a long way down here to come to this seminar. You get 70 cents a mile as a write-off for the trip down and back. That's a good break. Unchanged is your moving and medical mileage, still at 21 cents. How many clients do you have that itemize, that still track their medical mileage? Boy, that is a loyal group, isn't it? Ben, you didn't ask me about my medical mileage and my medical parking. Oh, excuse me. Let me get that in there real quick. I mean, they are real, and they are very vocal about wanting their medical mileage and their medical parking fees. So it's only 21 cents. Okay, you had 200 medical miles. Boy, that's a big deduction you got there. Okay. And charitable mileage is still at 14 cents. That's by statute, so it does not change. All right, standard changes and additions. All right, these are basically things that have been here for a while, but I'm just bringing them back up for review. Your American Opportunity Credit still at $2,500. Any excess deductions on the final K1 of an estate, yeah, I guess it's just going to be, it's not going to be trust. Just on an estate will show up on the K1s for the individuals. How is this going to benefit them? If it would apply to an itemized deduction, your program should automatically, if you list it on the K1, your program should carry it over to the itemized deduction Schedule A, and it's going to show up over there. So sometimes I've been surprised. I'm looking and I'm saying, well, wait a minute. I know what the total was, and then I realized, oh, but we got a K1, and those were excess that came over. So, like I said, you're going to have fun with this year's tax return, because there's going to be a lot of things that show up on that tax return that you're not used to seeing. And if you haven't been paying attention on what's changing, you're going to be scratching your head a little bit saying, why did that change? So just be aware, there are going to be a lot of changes that your program's going to handle, but you're going to have to keep up. So, okay. We talked about teachers' expenses. 179 depreciation. It is now up to $2.5 million for 179 election. But if we got 100% bonus depreciation, why do we even need to consider 179? I mean, you might want to do it, yeah. But it's an extra, as Roger was saying, it's an extra tool in your tool bag that if you need it, you got it. But it's going to take you all the way up to $2.5 million a year. And the phase out on it is up to $4 million. QCDs. Now, this is one thing I was hoping Roger would talk a little bit more about. This has always been one of my favorite issues. But it only hits a select number of people, doesn't it? Yes. What's the magic age for qualifying for QCD? It's on the board. 70 and a half. So, but do we have clients that are 70 and a half or older? I spend a lot of time talking to them if they can't itemize. And up till this year, and I really don't see a lot of changes with most of my seniors. Most of my seniors, I'm lucky if I get 1 out of 20 that can itemize. Most of the time it's lower than that. Yeah, unless they're big money and unless they're, and I don't, like I said, I don't see a lot of changes with the SALT. For most of them, they pay the reduced property tax bill anyway. And there's not, usually a lot of other taxes that are going to help them qualify to itemize. Remember, a married couple, both over 65, it goes up over 33, 34,000 this year as a standard deduction. So be aware of the fact. Coming back. Okay. Do I need to go back a screen? Slip back a screen for me, Jam. Yeah. The QCD, once you hit 70 and a half, I'm convincing a lot of them, especially ones that give a lot to their churches or to other charity organizations, if they've got $10,000, $12,000 in charity donations and they're unable to itemize, that's lost. Now this year, will they each qualify for $1,000 a piece outside of itemize? Yes, they will, but that's still not enough. What advice can you give them for next year that's going to really make a difference on their taxes? Hey, you got an RMD for $20,000 and you're giving $12,000 a year. Why don't you get your RMD to donate out $12,000 to these different organizations? Well, how's that going to help me, Ben? It's going to drop your taxable income, your AGI, by $12,000, something you can't do right now on Schedule A. And you're still going to get the standard deduction of $33,000, $34,000 a year, plus you get $12,000 off because you had your RMD send out the money to the different charities. Well, Ben, how do I do that? Tell your broker you want to do QCDs, qualified charitable donations, from your IRA or from your SEP. I don't think you can do it from a 401k, but you can convert money over to an IRA and then you can do it. So if you got RMDs, flip back for me again. If you got RMDs, you can go up to $108,000 a year. Now let me tell you something that's just nothing, I can't explain this other than a blessing from God. I put $40,000 into my SEP this past May. Okay? And I don't know how many of you listen to Charles Payne. He's another one. You got Motley Fools and a lot of different sources. But I was paying attention to Charles Payne. And I invested that $40,000 with the broker into suggestions that Charles Payne gave me. Okay? Last month, that same $40,000 had grown to $81,000. Well, I had already committed this money to God. I said, Lord, whatever I get in the SEP, I get to write that off as a deduction on my 2024 tax return, even though I didn't pay it because it's a SEP. Remember, I had an extension. I was good till October 15th. So in May, I made my $40,000 contribution to the SEP, after tax season, of course. And that's money that every year, instead of going with the RMD game, I just say, okay, I got these 4 different charities that I want to get $10,000 a piece. And so all that money is immediately dispersed to the different charities through a QCD. Well, now this year, if the stock market stays up, I've already told a lot of them, a lot of them are calling me because $10,000 is a lot of money for some of these charities. Mr. Tallman, are you going to help us out again this year? Yes, I am. Well, we were just hoping we could get an idea. I said, about the 1st of December. I said, I want to give this time to get to the 1st of December. But right now, if I stay at 80 or above, that money's all going to go out to these different charities. Some of these charities might really be surprised. Atlanta Community Food Bank, Feeding America, Samaritan's Purse, and the Central Pres Homeless Shelter. Those are the, but instead of 10, looks like they're all set up right now to get 20 grand a piece this year. And because it's under 108,000, it can all go out that way. Now, and again, I don't say this to reflect anything on me. This is all blessings of God. I made an agreement a long time with the Lord. I said, whatever I put in the SEP is yours, Lord. I'll distribute it at the end of the year. If you want it to grow, these groups are going to get money. Now, my wife was impressed. And she's hard to impress with investments. You heard me talking this morning. And when I told her, I said, I'm up to $81,000 in this account. She said, what? She said, you just put how much in there in May? I said, 40,000. That, when you can double your money in 5 months, that's divine intervention here. Huh? Oh, she knows. She knows that money goes. Yeah, yeah.
No, Charles Payne, did you tell her?
I haven't told Charles yet. I might get me on one of his TV shows. That might be a good idea. Okay. But I got to remember, God gets the glory. Okay. So just be aware. That's a great way to give money out if you're going to give to charities. If they're generous anyway to their charities, have the money funneled through the RMD and they get an immediate write-off. Now, they get that 1099-R at the end of the year. Mine still says 40,000. But what I do is there's a little box, a little check box, and I can say all this money was dispersed through QCDs. And what will happen is on the 1040, it'll say 40,000 received, QCD, and then it's going to show zero taxable. So you still have to make a manual change with a checkbox to tell it to take the money QCD. I have a few people that forgot that we get it all off on the front, and they're still saying, okay, Ben, I gave this much to this church and this and everything else. And then they'll say, now what's this thing that you were telling me about on my RMDs? And I'll say, oh, all that money was through your RMD? Yeah, didn't you know? You got to ask sometime.
I usually attach the letters just to verify or
Yeah.
solidify my check.
Okay. So Kelly, good point. She said that she likes to verify and make sure. So, all right. I'm sorry, Jan. You can go on to the next slide, buddy. I keep pulling you back over here. All right. RMDs, age 73 right now. What if you were born in 1959 or later? You go to age 75. So you got clients that were born in 1959 or after 1959, their RMD is now age 75. Okay. Where are we?
Mr. Dillon, we have a question.
Yes.
You want to read it?
All right. Flipping up on the screen. Just from Susan Barn. Oh, can you do a QCD from a retirement trust that receives the RMD? Susan, I think this only works on 1040s. I don't think it's going to work on a trust return. I am not aware of anything like that. I wish that did work. I understand the trust is having to do the QCD. I mean the RMD.
Got to be out of an IRA.
It has, yeah, that's right. It does have to be out of an IRA or a SET. So that's going to be your biggest problem. Now remember, you have the tax benefit rule. If you're already getting the tax benefit by putting it in the trust, government's not going to let you double dip and get it somewhere else too. So that tax benefit rule, that's the thing I'm able to fall back to. Has a tax benefit already been achieved by putting it in this vehicle? And if it has as a trust, then you're not going to get a second bite of the apple. You're not going to get a double dip. All right. Business meals, back at 50%. Again, if you have businesses that deal with food stock that expires, this is a great way for them, rather than reducing, if they're in a restaurant, rather than having this week's special, trying to get rid of all that tomato sauce or whatever they might have, or you have a retail store that sells food, if they donate that before it expires, if it's going to expire in 6 weeks, if they donate that food to a food bank or to a charity organization as a 501c3, then they get 110% write-off for it. Not only do they get the full money that they paid for it, again, they bought it wholesale, but they also get a 10% bumper on that because they donated it to a food bank. Okay? So if they got food that would otherwise 6 weeks from now go out and get thrown in the dumpster, if they give it away before it expires and give it to a charity, they get 110% of their cost back. So be aware of that. C corporations, they get, remember, C corporations have always been able to deduct up to 10% of their taxable earnings for charities. And if they donate more than that, what happens? Becomes a carryover and they get it in the future. But just, do we still have subchapter S's and LLCs that donate money to charities? And what do we have to tell them? That's not a write-off for your company. But Ben, the company wrote the check. I got the check right here. It doesn't matter. The law says the company doesn't get to deduct it. It's going to come down line to you on a K-1 and you can use it. But up to this point, if they're not able to itemize, where does that go? Just evaporates, doesn't it? Okay. Again, remember, up through the end of the year, 5695 will probably become a dead form after the end of this year, won't it? Because this is the last year that they're going to get any of these household energy savings credits. Okay. Next slide, Jim. All right. We know first year bonus depreciation, 100%. If you have listed property, what's listed property? It's a vehicle that weighs less than 6,000 pounds and used for business, and it must be used at least 50% or more in that business, right? Because if not, you got to go back and pull the depreciation and everything else. You get into a mess if it drops below 50% use. So for listed property under Section 280F and under Section 168, you get to deduct in the first year $20,200 up to $20,200 for a car, a van, or a truck. They're all now equal with the government. They stopped separating them, giving the trucks and the vans more. Okay. Second year, you get 19,600. Third year, you get 11,800. And all future years, you get $7,060 until the money runs out. Okay. For SUVs, I don't know why they continue to play this game, but for SUVs, what happens to a 179 election on an SUV? Now that's assuming the SUV is under 6,000 pounds, okay? So it's going to fall under 280F. And what's going to happen is the maximum on the 179 is $31,300 this year. Okay, new and used SUVs or trucks with a 6-foot bed over 6,000 pounds still qualify for the 100% bonus depreciation. And you see the date up there that I mentioned earlier when Roger was up talking about this. Had to have been purchased on January 20th or later this year. Now, you heard me give you an explanation that might help get around that rule. If your client says it wasn't put into service until January 20th or later, then we can get it on the in-service rule and it will qualify for the 100% bonus depreciation. But if you bought it and put it in service by January 5th, and that's your word and you're sticking to it, you don't qualify for 100% bonus depreciation this year. Okay. Work opportunity tax credit is still there. It extends through the end of 25. The new markets tax credit has been made permanent. Energy efficient improvements, you heard me talk about that yesterday, takes you up through June 30th of next year. And the home builders energy efficient credit, that little rascal has been dead since 2021. That's the last year we were able to take that. Okay, again, 30% wind, solar, all expires the end of this year. Okay, 529 plan. Still can take out up to $10,000 a year for 2025. Look what happens next year. 2026, that jumps to $20,000 a year that you can pull out to pay for private school tuition from kindergarten through the 12th grade. And for children under the ABLE account, it's $15,000. Now, they haven't shown yet in their regulations that that has doubled to 30, but I'm sort of expecting it probably will. Okay? It just was not listed in any of the regulations at this point. I'm sure somebody's going to have to point out to them that, hey, you forgot to tell us about the people with the ABLE account. You doubled the other. How about doubling the ABLE? Okay. Still have the same situation. You have a college student that works on campus. You're already seeing, or you have seen in the past, that they're not being taxed for Social Security or Medicare tax. But now, under the rule that's actually been in play for a couple of years, they're technically, if they're working for the college or university and the W-2's coming from there, their income is no longer taxable as long as they're still enrolled as half-time or longer at that university. So if they're still a student there and they're working there in the cafeteria or wherever in the library, their income should also be exempt. If it's not, somebody needs to talk to admissions. No, it wouldn't be admissions. Who would handle it? HR probably. And find out why their child is being taxed when the law says they don't need to be. Oh, that's interesting. So Kelly, you've actually filed a tax return where that's done and asked for the exclusion and pulled it back. And it worked?
It worked. It's hard to do with the
Huh?
How to get the W-2 excluded? That'd be challenging. No, the W-2. They would count Social Security and Medicare, and they were exempt from that. So we filed a tax return to get the Social Security and Medicare. I'm trying to think.
Oh, no, I'm talking about taking off the income tax.
Oh, I haven't done that.
Oh, okay. You had me confused. I'm going, let's see. How do we get the income tax taken off? Okay. That one you're probably going to have to go back to the university and get them to clean it up. Now, the one place you might not have any luck is you may get a W-2 with only state income and state income tax withholding. Because even though the federal government's saying we'll wipe out the first 6 lines, the state says, no, we want our money. Bring us the money. So, just be aware. You might get a W-2 that really looks strange with just state income tax on it. All right. Okay. Yeah, any of you work with the pay.gov? We have to use that for our PTIN numbers and stuff. And it's becoming more and more standard. You'll probably get a registration. And okay, Jam, next slide. Student loan forgiveness. The only way you're going to get student loan forgiveness right now, tell you what, Jam, if I moved over here, I know you're going to have to move your camera a little bit for me, but I can look here and I'm out of the way and I can still see the screen. Okay, student loan forgiveness. If you have forgiveness due to death or disability, then it is going to be excluded. Okay? It's not taxable income under the federal program. Foreign income tax exclusion. Okay, that's up to $180,000 now. And housing expenses in a foreign country that go above $20,800 will be deductible. All right. FSAs. FSA deduction for employees is now up to $3,300. Well, how many of you remember when it used to be $5,000? So we're starting from the ground again and they're rebuilding and they're going up a little bit each year. So be aware they're up to $3,300 now. Okay, employer tax-free parking and mass transit passes, they stay at $325 a month, excluding the $20 for the bicycle. commuters. I don't know why they went after those poor bicycle folks. I mean, like I said, that was only $20 a month. Why are you beating up on them? You're leaving everything else there. And we're almost up to 2 o'clock. Here, you're going to pass that. Let me just, all right, Jam. It is time again for you folks online to follow the wording at the bottom of your screen and text your full name into us here at that number. Okay, so let's go back over. And you heard me say earlier, estate and gift tax has gone there, and we're up to $19,000 a year on gifting. I thought that was in 26, but I'm just looking now and I realize 19,000 applies for 2025. So they can give up to $19,000 a year to any individual without having to worry about a 709 gift tax return. And remember, you can still preload your 529 plan for the next 5 years. A couple can give up to $190,000 towards any child in the 529 plan. But when we talk preload, what does that mean? It means they can't give anything for the next 4 years. Okay? So it gives you a chance to go ahead and shove $190,000 into the 529. With a good stock market going these days, maybe it'll grow. And but that exempts them out for the next 4 years. So no gifts coming up for the next 4 years. All right, Jam, next slide. Stepped up basis is still in place. AMT exemption thresholds are $137,000 for married filing joint, $88,100 for single head of household. You can still be fined and penalized for being late with W-2s and 1099s.
Have you ever seen that happen? I've had clients that get me the information.
I've heard of it happening, Kelly. I have. So I would say it would have to be large enough to catch the government's attention. If you're only doing 3 or 4 or 5 different forms on a W-3 or on a 1096, might not see it. But if you got like 25 or 40 or something, it would be worth them going after it. $60 for 30 days a return, plus $340 after August 31st. Now, be aware of the fact that there is now a VIN number database, and you got this information in your material as well as on the slide. If you want to check on the fuel economy for any car, for your particular car, put in the VIN number. It'll tell you what that vehicle is supposed to produce as far as miles per gallon. So, just for people that are sort of geeks, or I like the word geek. Roger used the word nerd, which I do understand, but that's from an older time period. Geek seems to have taken over the word nerd. So, all right. Which still should be treated with a lot of respect. Don't get me wrong. Without geeks, we'd all be in a world of hurt. I can tell you right now. Okay. Well, you're probably right, Bobby. You're really right. If we weren't nerds, why would we be in here today? I definitely agree. I understand. All right. BOI filings. Boy, was that a dance or what?
Yeah.
I mean, it was like, I think it was a way for the government to raise $10,000 off the backs of corporations and companies because they didn't satisfy that requirement. Did it have anything to do with us? No. But who would have been blamed had our client hit with a $10,000 fine? We would. Ben, you should have told me. I probably sent out 2 to 3 emails during the year warning them. Said, you need to go to this way. I cannot do it for you. I told them right on there. I cannot do it for you, but you can do it online. Will probably only take you 10 to 15 minutes.
I thought the lawyer should do it, and the lawyer told me don't do that.
No, there's no money. There's no money for the attorneys to do it. I mean, if they can't charge $1,000, $1,500 for something, and it's only going to take them 15 minutes online to do it themselves, why would they pay an attorney $1,500 to do that? Now, I saw some accounting firms that were advertising online to do it, but they wanted like $300 for 15 minutes of work. I mean, I think 300 is probably a good rate on an hourly basis, but for 15 minutes, they're getting over. Private letter rulings. This is just FYI. Federal poverty level. I think you should always try to stay up on the federal poverty level. You see the figures for 2024. Or did I actually forget to put a 5 where the 4 is? I think I did. I think these are actually, okay, folks, these are actually 2025 figures, and I just forgot to change my slide. So these figures, if you would make that correction on your material, that this is 2025, not 2024. And these are just the federal poverty levels. Usually it has to do with healthcare.gov, okay? So be aware of the fact that some of your folks come in and they don't understand why they owe $13,000 in tax. And I'll say, when you got your healthcare.gov, how much did you tell them you were making a year? I don't know, Ben, maybe $40,000 a year. Okay, and this year you made $156,000. You think you might have missed the mark a little bit? Yeah, if you missed the mark, then guess what? You got to repay all those subsidies.
Yeah, the first time I laughed, they had to pay it, the insurance company wanted to do that. They dropped that stuff. Wait a minute, we didn't understand that.
Like, we're not doing that anymore.
Is the BOI still valid? To my knowledge, I think it's dropped off. I think, for foreign?
Still only
Foreign corporation.
So it's only for foreign corporations now. It looks like wiser heads have prevailed and taken it offline. So, because I haven't read or seen anything of it coming back. So yeah, I would say it's done, it's over. All right, there we go. All right, now again, I know this is crazy stuff, and Roger's even saying, why would you have long-term care premiums anymore? But if you do you still have clients that pay long-term care premiums? Yeah, we all do. Remember, there's a cap on this, and if they pay more than that in a year based on their age, your program's going to come in and probably reduce that. Now, if they're not itemizing anyway, will it make a difference? No. But here's the real kicker on this. The reason you need to ask them, are you paying long-term care premiums? If you're self-employed and you pay long-term care on you and your spouse, and let's say just for a bonus, you also each pay Medicare premiums, can you do anything with those premiums if you're self-employed? Absolutely. That is all 100% deductible up to your income on your self-employed business. Now, is it going to knock off Social Security tax? No. But will it knock off income tax? Yes, it will. It's going to come off above the line on the 1040. So just be aware of the fact that the reason I'm even mentioning this is because if you're on a Schedule C or a Schedule F, you're going to get to deduct those healthcare premiums that you're paying.
Well, it's a flow through as long as you're stepping to it.
Yeah, you're going to have your flow through on that. Now, remember, if you're paying health insurance premiums on your sub S for yourself, do you have to pay tax on that on the schedule, on the 1040? Yeah. And shouldn't there be an attachment to the K1 saying health insurance premiums paid on behalf of this owner? And it's going to list that amount, and you carry that over to line 8Z on the 1040, and that's where you're going to go ahead and add it back in as additional income. Okay, next slide, please. 2025 F bar. How many of you still fill out FBAR for your clients? Really? You know what? I've gotten to the point because I don't want the responsibility of remembering to ask that client, do you have an FBAR? What I tell them is I'll say, now I'm doing it this year as part of your tax return. Next year, if you can't fill this out yourself, I'm charging you $500 just for the FBAR return. Well, Ben, that's kind of high. It's only going to take you a half hour. I said, exactly. But I said, I don't want the responsibility that comes with it. Save $500 next year and fill out your own FBAR return. Because otherwise, you know the penalties on these things. My E&O won't cover this. When you're talking $10,000 a pop for penalties, and that's the minimums, my E&O is not going to pick that up because I forgot to do an FBAR on somebody. Not me. I don't want anything to do with them. I'd up your fees so much that it forces them to learn to do it themselves. And can they now do it online? Yes. But it's your responsibility. I'm not taking that responsibility unless I am grossly compensated.
Have you noticed how many people check you have foreign accounts and they say no?
Yeah.
And they do.
Yeah. Oh, yeah. You have any foreign bank accounts? You have any foreign accounts? All right. So now, if you file an extension, the 4868, that's automatically going to extend your FBAR till October 15th. We already talked about that one. Let's go to the next one. Okay, cancellation of debt. Are there exceptions to a 1099-C? Yes, there are. And let's take a look at those. If you had filed for bankruptcy or insolvency, if you have loans that become gifts from family members, qualified farm indebtedness, qualified real estate business indebtedness, qualified principal resident indebtedness, those are all exceptions that you can go fill out on Form 581. For some reason, that's a number that's sticking in my head. Is it 981? 981 sounds good. 981. Yeah, but you got to, usually when you key this in on the 1099-C, it's going to give you a checkbox that allows you to go to this exception form, and you fill out the exception form and you're good. Okay, we're good for the next one, Jam. All right, inherited Roth IRAs, employee retirement plans. Okay, do me a favor. When we get to 250, yeah, you don't have to give me, but just give me a break. Okay, I don't want to miss the break. Okay, if you inherit Roth IRAs, employee yes, another question on the table. Let's see what we got. Okay, if you have self-employed health insurance included in box 1 of wages, but not subject to Social Medicare, are they deducted on 1040? Is this true? All right. If you've already, remember the tax benefit rule we were talking about earlier? Get back on the camera lens again. The tax benefit rule says if you've already gotten that break somewhere else, can you double dip? No, you can't get it a second time. But if you paid tax for that and it was included as income and you have not gotten a tax breakthrough, but here's the problem. If it's employer paid, it doesn't qualify if you got it on a W-2. It only works for self-employed people. Okay?
Ben, I thought, I'm not sure of her question, but when you said it before, I thought for self-employed, not self-employed, but S corporation, 2% owners, if they have a W-2, they're allowed to get the above the line deduction for health insurance
As
that's
long as
paid
it
by the clerk.
wasn't
As
deducted.
long as it's included in their W-2.
Okay.
The W-2 is online, what, 7?
So the health insurance has been added to their income.
Right,
So they haven't gotten a benefit for it yet. So if they are getting this through a K-1, yeah, that would come through on the exception.
right,
But that's for a closely held
yes.
subchapter S corporation.
C as an employee, you may
Okay.
not deduct it.
So
I'm not sure if that's.
in answer, if that's the scenario you're referring to, then yes, then we are okay. You can take it. But remember, just come back to the tax benefit rule. Has the company or the individual already received a tax break on this? If they have not, and it is a closely held S corporation, then yes, in under the exception rule, you're going to be fine. You can deduct it.
Do you think they were thinking it was a medical deduction since it was paid with, with not?
Now, if you've got other medical plans, that's not a health insurance premium. So if you're dealing with a health reimbursement arrangement or a MSA or any of these others,
I have two clients that their health insurance premiums are after tax, not pre-tax, so that goes on the itemized deduction schedule under medical, if they have enough other medical.
okay,
See what I'm
but that's not for a closely held S corporation. That's for an individual employee. Okay. Her question was actually involved with an employee working for an employer, which again is excluded from that deduction of taking the health insurance for a self-employed individual. So usually that throws it out. The only other exception we have where it's counted as taxable income on the W-2 for a closely held S corporation. And by the time you get far enough down that tunnel, there's no place else to turn. You got to be very precise to hit that. Okay. All right. Be aware of the fact that if you have people that inherit IRAs or Roths or employee retirement plans, they're required to now liquidate those within 10 years. You have a few exceptions up here on the board. If it's the spouse of the deceased owner, what benefit does the spouse have in this case that nobody else does? They can roll it over to their own name, can't they? So guess what? They avoid any of this problem. They don't have to worry about the 10 year. They just roll the whole thing over. Yeah, Reg?
Got a question. On exactly this topic, what plant?
Test.
This way, it's not for the people in the room.
Online.
Okay.
Okay.
Take out an RMD
On her
for
husband's.
2025.
Well, she's already done 2025 on herself.
It sounded like.
No,
she
but
needed to
under
do
the one she rolled over.
Yes.
Okay. Somebody's going to have to grab an RMD on that. Either you spill it out from the estate before she rolls the money, or if she's the only beneficiary,
only
it doesn't go to
beneficiary.
the estate, then yes, she needs to take an RMD.
She needs to take an RMD. Okay.
Yeah.
That's not
Now-
what she, that's
now,
not what
what
she
they
wanted to
do-
hear.
Curious
What they
though.
do, now wait a minute, there is a rule that says, Reg, and I don't know if this would apply, but we have to, everybody stay with me just a second, because I'm gonna talk about what you're probably starting to refer to. Okay. They actually give you that first year as an inheritance, where if you inherited someone that was already on an RMD, they give you a grace period of that first year. Now remember, that a lot of that applied back around the time of the pandemic. And it impacted years like 22, 23, 24. Mm-hmm. But I think in year 25, that's, unless it's in Secure 2.0, I don't remember seeing it there, but unless it's in Secure 2.0, I think that ended in 24, where you get that 1 year grace. Mm-hmm. Now, at this point, let's go back and take a quick look at the screen. Jan, whenever you get a second. All right, go to the next screen for a second. Yeah, really 20 through 24 must begin RMDs in 2025. So up through 24, you would have gotten a grace period. But in 2025, it does make it a requirement. She has to take the RMD before the end of the year.
On her husband's.
On the money she's moved from her husband into her own account.
But it can be from one.
Okay, no, she's already taken 25 grand as her RMD for.
Will that cover both of the accounts?
Right, because it doesn't matter if you take it from me.
Okay, that probably was a question. I said your brokerage house ought to be able to do the calculation for you.
They take the full bucket and they make the
That's what I told her.
regardless.
Are they both IRAs?
Yes.
Okay. The only thing that confuses me just slightly, and it's going to require more research, and any of us can do this research, is that one of them is an inherited IRA, the other is a normal IRA. Mm-hmm. Sometimes under inherited IRAs, it's treated as a separate offshoot from IRAs. Now, since this is a spousal, it's not going to actually be considered an inherited IRA. She's going to move it into her own IRA, which tells me, Reg, unless you find something to the contrary in your 2.0 regs, I would assume that she's going to need to take this RMD. To be safe, unless you can find something to the contrary, to be safe, I'm going to tell you, have her take an RMD between now and the end of the year.
Well, she's already done her own for this year.
Right.
At 25,000. Her question was, now that she's got her husband's in there,
she needs to go back to the broker and say, am I taking enough out to cover both?
That's basically what I told her. I said, it's in the same pot now. They should be able to go back and do the calculation.
This is beyond you and me coming up with an answer here. She's the only one that can come up with the answer, and she's going to have to talk to her broker. We can't resolve anything. We cannot give her the answer she desires. She's waiting for you to say, no, you don't have to do that, sweetie.
No, well, I've already told her. I said, your broker should have gone back and calculation for you.
Okay. Agree on that. So this one's back in her court.
Well, that's where I put it.
Okay. All right. So back on screen, Jam, if you would. All right. Talked about spouse enough before that one out. Beneficiary is a child of 18. You come out, you go back to old rules. We get this out for either the was on the RMD or weren't receiving RMDs at the time. The child can go on their own lifetime schedule, but they're going to have to start taking RMDs. Okay? But there's no 10-year requirement. But if the deceased was on RMDs, there is no choice. You got to stay on the deceased RMD schedule. Yeah. So aware, there may be an exclusion if there's less than a 10-year gap between the decedent and the one inheriting the IRA. Now, all it's going to do, it's going to take away the 10-year RMD requirement. It's going to make it a lifetime RMD, which is okay. I mean, we go back basically to the pre-2020 law for the Secure Act. And that means that they're back in the old rules that used to be lifetime, or actually you had up to 5 years if you weren't on these exceptions. Okay, next slide. You know, this is scary. The older we get, we see all this stuff. And I know it's tough for a lot of the younger folks that are in this business, of which I see none in this room. Which would mean that you folks out there on the internet, the online folks, if you're young and doing this, by all means, my hat's off to you. Because us old timers, we've been through stuff and we can go back and quote where the law was 5, 10, 15 years ago. It's scary when you go back and you think, wow, I've acquired a lot of knowledge in that amount of time. I've actually worked in those times. So, okay, let's get back. Do what?
You don't have to take a deduction, a distribution each year. You can wait till the last 10 years, or is there any?
No, if they're under an RMD, you must take a deduction every year. And it's all got to be gone in 10 years. Now, the exception is on a Roth and actually on an IRA. If they're not currently under RMD, if they're not under RMD on a Roth or an IRA, then you can wait until the 10th year and grab it all in the last year.
May not make sense.
And that's where you get into tax strategies. So you're right. The whole thing is the person that died, were they on an RMD? If they were on an RMD, then that path is already set for them. They're going to be taking the money out every year, and by the 10th year, they take the balance. So, but if they're not on an RMD, if it's somebody that's in their mid-50s and they're not receiving anything yet, all options are open until year 10. And then it's including the Roth. So on year 10, you got to drain that Roth account too, which is sad because,
I don't understand that.
well, we always used to say the benefit of the Roth account was that it's not only good for your lifetime, but it's good, you're building wealth for your family so that your family's going to benefit for their lifetime. Well, guess what? The Secure Act changed all that when it put a 10-year cap on it. So, okay. Let's go back. Okay, we've already discussed this. Next slide, Jim. We've discussed this. We've discussed that. Oh, no, go back. I'm not quite. Okay. Roth 401k owners are not subject to RMDs, 50% of RMD penalties. Okay, remember when they used to have a 50% penalty if you didn't take an RMD, the government can come back and snatch up to 50% of what you should have taken that year? Well, that's been reduced to 25%. And if you have certain exceptions that apply, you might even get that down to 10% of the RMD. So be aware that there's some interesting things. If you withdraw money out of a IRA for the birth or adoption of a child, and I think the cap on that is $5,000, you can repay it within 3 years and not have to pay any tax on it, okay? Remember, even then, you still always owe the tax. You just exempt out of the penalty. The 10% penalty goes away if it was due to a birth or an adoption. Student loan repayments, and we talked about this, the employer retirement matching, 5250. Oh, I'm sorry. No, this is something separate. If you have an employee that's paying back on student loans, they can get the employer, even though they didn't put money into the retirement account, if they can show their employer that they paid $10,000 back on their student loans, and if the employer will match up to $10,000 in a retirement account, the employer can drop $10,000 in that retirement account, even though they haven't paid in the first dime. So what they're doing is they're allowing you to swap out repayment of student loans for your employer's retirement contribution to the employer retirement plan. Make sense?
He gets the deduction, you get the money.
Yeah. I mean, it's great if you're paying back student loans and you can say, hey, boss, I paid back $10,000 on my student loan. The government says you can go ahead and give me that match on my retirement account right now. Well, they'll probably talk to accounting before they do anything, but once they find out that they can, they could go ahead and match up to whatever the maximum is on your student loan repayments.
That would require a written plan on the part of the employee.
This is saying the employer can do it. Yes, almost all these things are governed by a written plan. Yeah. So yeah, it would have to be an employer plan that's in writing, but it's available. The government says we're open to it if you want to do it, Mr. Employer. Okay, next slide. All right.
The interesting thing is bullet point number 2, so you don't have to have earned income. You know, before people, you know, that 529.
529.
When you roll it into a Roth, it used to be you couldn't make any, but I guess a rollover into a Roth is the same thing.
I don't think the 529 has an employment requirement to it.
No, I was just saying when you roll it into a Roth. I just find that interesting.
Oh, okay. Well, let's get over there. Give me a minute to get there. Okay, unused 529 can now be rolled over into a Roth IRA. All right. That does not require that you be employed. Now, there's a lot of exceptions to this, Kelly.
Okay.
So be aware, folks online, there are a lot of exceptions to this rule. You want to read over the detail on this before you try to make that move, because it's like stand on one foot, rub your belly and tap your head. And if you don't get it just right, they'll come back and say you did it wrong, we're going to tax you on it. So make sure that you read all the specifics on that, the caveats, to make sure that you're doing it right. Public service.
That'd just be fun that you had, I mean, the plan had already sent the grandchild to school and there's excess funds in there. You can't just put it in the 529 and then all of a sudden say, I want to move it to a Roth.
No. Usually this is a situation where you've had your oldest child, your youngest child reach 30 years of age, and now you can no longer use it for college unless it goes to a cousin or a nephew or niece or somebody. So this gives you an opportunity, if you wind up with 529 money still in the account, it gives you an alternative to move it back to a Roth account, which is a nice benefit. But Bobby, I would have had to fill up 3 screens to hit all the exceptions on how to hit this right. So this was one of these fairy godmother gifts that Congress bestowed on us with the magic wand and said, look what you could, aren't we great people? Look what we did for you. I mean, it's just one of these things. It looks good. Look at here. We told you could take the excess 529 money and move it into a Roth. Aren't we wonderful? Well, it is great, but like I said, there's limits to how much you can do each year. There's all kinds of exceptions. Before you try that, go back in and read the regulations. Okay? All right, let's go back and take a look here. Where are we? On the next screen. Public safety officers. Yeah, they can retire now at 50 years of age with only 25 years in, which means they were only 25 when they started working there, right? Not a bad deal. Now, they also get to deduct up to $3,000 a year for their health insurance premiums. And that's another great benefit. Yeah, we have a lot of retired firemen, EMTs, police officers. They all get to qualify for that $3,000 a year that they're paying for health insurance. In 2025, the government's going to release a retirement account database. Well, the fact that they're closed right now, I'm not holding my breath.
There's a lot of stuff like that.
But you want to also realize, is it not picking up? Okay. All right. So the issue here is when the government reopens, maybe we will see a retirement database. How is this helpful to all of us? Well, you can go on the database for someone that's died. You can put in their social security number, and you can see if there are any other missing retirement accounts out there under their name and their social. How many people, when they die, say, well, I'm sure that Uncle Jim had all these other retirement accounts. If you can't find them or locate them, this database should help you or assist you in doing that.
We do the 4506T, which will show you the 5498s and all that other kind of stuff.
But the 5498 is supposed to go out on every retirement account, isn't it?
Mm-hmm.
Okay.
So we've done that.
So you did it through the IRS database. She did this through the IRS database looking for the 5498s to show. Now, what if they didn't have his current address? Wouldn't get a 5498. This is taking it out another level. If he's moved 6 times since he had that retirement account at the age of 32, sometimes you get lucky. I know my dad was a volunteer fireman for 15 years and qualified for a death benefit. And 4 years after my dad died, they tracked me down as the executor, and they said, your dad was volunteer fireman for 15 years. He qualifies for $7,500 death benefit. I got 2 other brothers. We split $2,500 apiece. It wasn't bad.
Nice.
But you see, it's nice that they go out and try to find you on stuff like that. That doesn't always happen. That's the problem. Okay, let's see where we are. Okay, so be aware of the fact that database should be coming, but it may not be until sometime later in 26. Auto enrollment into the employer's retirement plan. Now, rather than ask the employee, do you want to join the retirement plan? They automatically get enrolled unless they do what? Opt out. Now, there are exceptions to this automatic. If you're a church, government agency, or you have less than 10 employees, or you've been in business for less than 3 years, you meet the exception for having to automatically enroll your employees into your retirement plan. Okay. Crypto and digital. Where are we on time? About 15 minutes? Okay. All right. What is it? How did it start? U.S. military developed cryptography. Okay. Back in the 1950s and 60s, the military was the one that was looking for something that they could do to send encrypted messages that couldn't be broken or cracked by the enemy. So they came up with cryptography. And cryptography, let me explain to you, and you've probably heard me talk about this before. You've been in my sessions, I know. But for the people out there online, maybe you haven't been to my session before. If you go on a website and you're looking up at the web address, and you start to go into that website and you go down 3 or 4 different levels, go back up and look at that address. That address is now expanded, and it's got all kinds of letters, numbers, symbols. Anything that's on your keyboard is up for grabs. Now, there's no way you and I could memorize or even decipher something like that. But a computer can do it, especially with an AI computer, could take something that's a half a mile long and decrypt it that quickly and tell whether it's matching up with something that it's looking for. So They call this blockchain. Blockchain is a long series, can be 100 yards long, can be a half a mile long, of all kinds of random numbers, letters, symbols, anything that you find on your keyboard could be part of this blockchain. And inside these blockchains, they hide special codes which only they know how to interpret. So to you, it just looks like random, it looks like your 3-year-old got on the keyboard and had fun. Okay? Does that make sense? And to you, it just looks like random stuff. But to the computer, it knows how to read this. It spreads things out, does all kinds of games. This is why when they make cryptocurrency, they have to have a supercomputer to do it, because they make it so complex that the computer knows how to dissect this thing and break it out. And they can do all kinds of things with blockchain. They can have the blockchain tell them what number Bitcoin they are. You know, Bitcoin has a maximum of 21 million Bitcoins that can be mined. When I say mined, it's not like you go out into the ground and you're digging your way down looking for a Bitcoin. You're doing this with a supercomputer, and when they call it mining, it takes, usually a supercomputer takes 10 days to 2 weeks to create a Bitcoin. And that's spending 24 hours a day during those 10 days trying to create this whole format. Now understand, Bitcoin sells them the package, but they have to create it. So you've heard the word data mining? This is where they go in and they take all this data and they mine it, and then when they're through, they create the Bitcoin. Now, the original people that were first selling the rights to mine Bitcoin were selling these things for like $50 a piece. And even back as recently as 2013, you and I could have gone online and bought a Bitcoin for $272. Now, my wife keeps asking me, she said, "You've been studying this stuff on Bitcoin for all these years. Why weren't you smart enough to at least buy 2 Bitcoins?" She said, "We could pay off our mortgage with what we could get on 2 Bitcoins." I said, "Yeah, I know." So, this is funny too. We just bought in our neighborhood close to the kids back in 2018. Our kids asked us, "Well, Mom, Dad, you pay cash for the house?" "No, I got a mortgage." "Oh, what, 10, 15 years? I said, 30. "Dad, you're not going to live that long." I said, "That's not my problem." So it's good, you know, but now the wife's getting concerned. She's saying, "Well, we need to pay that down. So we'll drop in another large payment against the principal from time to time."
What do you have good interest?
Well, we got a 2.75% interest rate. Yeah, and with the stock market doing what it's doing right now, you know, wouldn't make any sense to pay off the mortgage. But if we had 2 Bitcoins that I could... No.
Then you have to pay the tax on it.
Yeah, I hear you. But, okay, we got about 10 minutes here. Let's see where we are. Okay, back up. All right, so you know what blockchains are now? They've turned it into, now they call it, first DeFi cryptocurrency was Bitcoin. That was established in 2009. DeFi stands for...
Defies logic.
No. DeFi. Something finance. What?
Digital electronic finance.
Maybe digital finance? No, it's not digital. But let me tell you something. The one thing about all the cryptocurrencies is they are not part of a hierarchy. They're all independent. Decentralized, thank you. Decentralized, so it's decentralized from everything else. Anything, if you go to a bank, they have a central bank somewhere out there, don't they? with a coin, with any cryptocurrency, they're all decentralized. What does that mean? They're independent bodies. They've been taught to operate by themselves. But here's the interesting thing. It's like they're all cousins and they all have a communication network. So they can communicate with all the other 21 million Bitcoins out there, and they do what they call a consensus. So if the original place that built Bitcoin says, we have an update for you, they can say, well, we don't know if we want to accept that or not. Let's ask our cousins. So what they do is they all go out and notify each other, and as a group, they make a decision as to whether or not they want to accept that update from Bitcoin Central, because they're all decentralized. So it's interesting that there are times that the group says, no, we're not going to do that, or yes, we are. And it's all based on consensus. So if the majority wants to do it, they'll do it. If the majority has questions or has concerns, no, we're not going to do it. So these little guys are free thinkers. Considering they were actually built back in 2009, yeah, they have had some updates on them, but that's interesting when you get into that. Okay, let's see what else we got here. So, people want to know, who was the father of Bitcoin? Well, this is the name that came out on the internet. I don't know if this was made up or what it is, but they came up with Satoshi Nakamoto. Okay, Japanese. Kanichi. Domo arigato. Doya tashimaste. That's my 3 words that I know. No, good afternoon, thank you, and you're welcome in Japanese. Okay, but coming back here, he is considered to be the father of Bitcoin. But has he ever come out of the shadows to claim that right? No. Why not? Well, if you're sitting on a business that you make a computer program with other founders, and all of a sudden you're one of the richest people out there and nobody knows you got the money, why would you reveal yourself? And that's the whole idea. Cryptocurrencies were made so that they couldn't be tracked, so that the government couldn't tax them. That's why we get the question all the time, do you own cryptocurrency? Did you sell any cryptocurrency last year? Because the government has no other way of finding out. All right, let's go. So, any of you own crypto or go through crypto broker? Robinhood? Coinbase? Nothing? Okay. Binance? Any of those? Okay. So what you'll have is you'll have a broker statement these days from like a Robinhood or a Coinbase that will show you, usually there's no dividends or interest, but you'll usually have stock sales. And it's fun. Sometimes they group them, sometimes they don't. Now, I don't list every cryptocurrency exchange. What I'll do is I may take time with my calculator and go through and add up all the basis and add up all the sales, and I'll drop it all in on one for that particular broker. And that still takes time. But go back up on the screen here for just a second. Okay, digital wallet. Now, what does the word digital wallet mean? Digital wallet means nothing more than, this is my account, but I'm going to spruce it up a little bit, and I'm going to say I have my coins in a digital wallet. Okay? It's just a fancy word. It's synonymous with the word account. Okay? So I have these crypto coins in my account, or I have these crypto coins in my digital wallet. So if you hear the word digital wallet, don't be intimidated. It's just a fancy word that goes with the crypto language. Okay? Okay, so let's go up and see what we got. We've got 5 minutes left. All right, so how do we show the ownership of the person that buys the digital currency? Well, you do that with a digital signature. Can you duplicate the same digital signature each time from now on? No way. So what does it happen? What happens here? If you buy a digital coin from somebody else, let's say you trade them cash or you trade them a car or something else for one of their digital coins. In the exchange of that property where you're now going to become the owner of the digital coin, you sign your signature one time. And then the computer comes back and says, what device would you like me to copy this digital signature onto? Most people copy it on to a flash drive. Some people copy it onto their telephone, which is stupid, because if anything ever happens to the telephone, you no longer have your digital coin. It's now out there waiting for you some day in the future, which will never come. You've probably heard stories of people that bought a lot of Bitcoin back in the early days, and they had it all stored on thumbnails or thumb drives. And next thing you know, somebody trying to be helpful in their family, Dad, I cleaned out your closet and I cleaned out all that junk in there. And they go digging through, well, what happened to all my flash drives? Well, we didn't know what was on them, so we just threw them away. Where? They're down in the dumpster. And Dad's down there in the dumpster looking for the bag to find those flash drives. Why? Because that's your only way to show ownership. So it's your digital signature that shows your ownership. Again, we know what the government's responsibilities say, that if you own it, you're supposed to go ahead and report or check the box. What's an airdrop? Okay, an airdrop is this. Let's say you own 10 Ethereum coins, okay? And Ethereum occasionally will do a spot check. They want to make sure that nobody's come in and created duplicates of what their coins are. They want to make sure that they don't have somebody coming in trying to steal their business. So they'll ask you if they can take a stake in your coins for the next 3 months. And they'll go through and run tests, and they'll make sure that they're authentic and they're not duplications. So to do that, they pay you a fee, a special stake fee, and they airdrop it to your account, usually your digital wallet. So if you get somebody that gets an airdrop, or if they say, yeah, I got an airdrop, but it was only for $32.75, do you have to report it? Yes. But it looks good. It adds integrity to your tax return. We counted airdropped income that came in. And therefore, yes, it's taxable. Is $35 going to change anything on the tax return? Probably not, but it looks good. Mining versus staking. I spoke to you earlier about mining. Mining is when you actually have the authority from that cryptocurrency to build your own with a supercomputer. Staking, I just explained to you. I've got 10 coins. I'm letting you look at my coins to see if they're authentic. And then I get paid a staking fee. Bitcoin's connection for consensus, we already talked about that. Storage of your digital signature, we've talked about. Who are crypto brokers? We've talked about some of those. And then if you have people that are actually old school and don't go through a broker, they have software with a transaction list, a detail list, and a block record list. Block record is for blockchains. So what you can do is you can actually pull those up, and it shows you all the transactions they had during the year if they're doing their own, if they're operating without a broker. And it shows you if they had any sales or if they bought new currency during the year. And they keep this record independently. There's 3 different types. And again, that is, go back a screen. That's a transaction list, which shows what the transactions were. A detail list would actually get specific. Okay, you had 3 coins from just different types of currencies. Or This is actually the blockchain information if you want it. So just be aware that you're not going to run into any of these, but I just want you to know for reference. Okay, with that said, let's go take a break.